Hello, everybody. My name is Dave Palamar. It's a pleasure to speak with you. I realize that there's some people listening live to this, and other people will access this later. Just want to let you know. Let me give you my background and let you know my entire purpose is to help you as best as I can. Uh, I think you're looking at a picture of me in front of an Abrams tank. I didn't have Abrams tanks. I was in the Army in the armor before that. I do need to offer a little disclaimer. I've been doing this as a volunteer. I know what I'm talking about. I spent 30 odd years in the financial markets and the investment business after my time in the Army, but I'm teaching this and doing the best I can. I'm not purporting or representing myself as a sanctioned expert, and I will not be held liable for any inaccuracies or if people take action based on my advice and they try to say to me, "Hey, you steered me wrong." I'm trying my very best to help you. So, financial literacy for military veterans and service members. Uh, Again, if someone here is live and wants to ask a question, I'd love to answer your questions. But this is the second of five modules of some gathered that I think is useful from a financial literacy point of view. So, just a little background on me. I come from a working class background. My mother, my father, my aunt, my three uncles, brother in law, and I all served. My father did not graduate high school. He was a New York City subway worker for 37 years after in the service. I applied to one college. I did end up having a heck of a time when I got out of the service trying to figure out what I want to do for a living and actually speak to veterans, giving them advice as to how they could figure out what they want to do for a living, prepare themselves as candidates, and to network efficiently. I don't have a PhD in that, but I have a PhD in life. So through my own experience and the brick walls that I hit, finally figuring it out, I offer people advice. This is the same reason for me offering financial literacy because I come from a household, I come from a neighborhood where nobody knew anything about this material, and I basically self-taught myself. Well, I learned myself. I think back to being at Fort Knox on the floor in my apartment in Radcliffe, Kentucky, which is right next to Fort Knox, with a notebook, and I wrote. 15 on the top of the page and 30 on the bottom of the page. And that's how I started doing my budgeting. And I figured all this stuff out. And I've just aggregated all this. And also, I do lots of volunteering and I teach people of different ages. And I just thought this would be very useful for you. So, second of five blocks, this segment is called banking. Again, I hope I don't say it too many times. Please ask questions. Raise your hand if you have any questions. So, banking. Granted, I'm an older guy, and younger people have different approaches and relationships with financial institutions, and maybe they don't want to be with a big bank because they think the fees are too high, uh, and they just want to have. They want to do things on their handheld, on their phone, or things like this. I'm not challenging that whatsoever, but it is important as you are in the business world, and granted, a small operation or two or three people running a startup business or a freelance business is an entirely different thing than someone working for a 200,000 person company. But if I could say this the right way without disrespecting anybody, the adult financial world wants you to have a financial identity, and they want you to have a financial relationship. So, not to appease older people, but for your own benefit, you'll be asked. It's a decent idea to have a relationship with a bank. You can probably shop for a bank that has the best fees and the best service and is not going to charge you uh, penalties for this and that. Some of those penalties are rude. Most of those penalties can be negotiated or even avoided because the rules by which they are imposed are very clearly stated. You may or may not like them, but there's typically not surprises. For example, overdrafts or insufficient balance. You may not excuse me, you may not agree with that, but that's the rule by which of a banking account. They say you have to have a certain amount between your checking account and savings account, and below that, we're going to charge you a fee per month. Or if you bounce a check, you probably shouldn't bounce a check. So we're all in the service. As a platoon leader, I spoke with my some of my soldiers, some of whom were 10 years older than me, and I spoke with their spouses. And I can vividly remember speaking to one of my soldiers' wives who felt that her checkbook, as long as she had checks, she could write checks. She didn't really grasp that there was a balance behind the checkbook or behind the checking account that represented how much money she had. And that was the basis on which she could write checks. But without me telling you what to do, being an old guy, it's probably a decent idea to have a bank account, to be able to write checks, to have a bank, because when you go to work someplace at a company, they're going to ask you, what's your bank account? Maybe they're going to make the one thing that makes a ton of sense is to have your check deposited, direct deposit uh, to your banking account rather than receiving a paper check. Paper check can be lost or stolen. Not to question anybody's discipline, but when you get cash in your hand, actually, if you receive cash or if you receive a check and go check it, it's just a little more orderly and easy to pay your bills, to make your investment as the very first bill you pay each month. When you receive a check and you have an account and you're online, or like I did so many years ago, a piece of paper in front of you, and you're allocating the money that you received in your presumably every 2 weeks check, or sometimes it's weekly. It's a decent idea to have that because probably most employers are going to ask you for that. So what's a checking account? A checking account is transactional. It typically earns little or no interest. It might earn, well, maybe nothing or 1 basis point. 1 basis point is 1/100th of a percent. So that's not very much. Savings accounts these days also do not pay you a very high return. The good news about banks, though, versus having the money in your pocket, or, well, that's probably the worst thing because it can be lost or stolen. But the banks, or the money that you hold at banks, or at a credit union is an aggregation of participating members. I don't think it's really important. If you don't want to ask, you can ask. But to explain the difference between banks and credit unions, but both are financial institutions that will hold your money, and it is insured up to $250,000. So that's important. So that means you leave the money there. While it may not grow because the interest rate stinks, you don't have to worry about the money not going there or being there because the institution fails. If the institution fails, the federal government will back it up at $250,000. So, with a bank, as I said, it's a good idea to have, it's called direct deposit. Direct deposit is when your paycheck is deposited directly into your bank and they're doing your budgeting, doing your bills. Whether you do it online or you write paper checks, you have your money, you're really clear on what your balance is, you're clear on your incoming bills. Of course, your first bill, and we'll talk about this in budgeting and savings and investments, your first bill uh, is to pay yourself first, to send money into your investment mechanism. Okay. So it's easily facilitated with a bank account, because with a bank account, and you'll hear things like ACH, actually, I don't know what that stands for, but it's an automatic transfer, and ABA number, your routing number. So you can, this is the numbers that correspond, your account number. These are numbers that correspond to your money, to your account, with a financial institution as your counterpart so that they can pay or receive money. But that's a really convenient way for you to remove the decision or the discipline and to automatically invest from every paycheck, say 10%, preferably even more, automatically drafts and gets deposited into a mutual fund or some sort of investment fund. So you don't actually have to write the check and actually have to make the decision. It happens automatically. That is a gigantic advantage, aside from the security of having your check payable directly to your bank account. Excuse me. So some people are or actually lots of people like debit cards, and debit cards versus credit cards, and pros and cons. So, debit card is something that you keep in your wallet, and it's kind of like having your checkbook in your pocket as you walk around. There's kind of good and bad news to that. I'm not really a fan of that. Um, Debit cards and credit cards, you have to read, and you have to read the material and ask the bank that issues them to you, the financial institution, if either somebody um, cheats you, by using your account and charges something against you, or steals your card, or you lose it. Unfortunately, when you go to a merchant, when you go someplace to use your debit card or credit card, depending on how old you are, in the old days, they would actually take your signature and they would come that you write on the bill. Say you go to a store and you buy something, clothes, or you go to a restaurant, you buy food, whatever. They would actually take your credit card and compare the signature on the back of the card, which you're required to sign the minute you get the card and the minute you activate it, and compare that to the bill you just signed. I can't remember the last time anybody did that for me. So one problem is if you lose, or if your debit card is or credit card is stolen, somebody can easily drain your money. And I just have more comfort with recovering it quickly from the credit card company, which is money that they are lending you, because that's what a credit card is. Okay. A debit card is your money. A credit card is lending you money. Now, you might very well get them both back, and you have to ask the bank or the financial institution that issued you. But I'm thinking to myself, if I'm walking around with my checkbook in my hand and I effectively drop it, or someone steals it if I lose, or someone steals my debit card, they can drain my bank account. And even if I'm going to get the money back, that just doesn't feel too comfortable for me. The other thing I don't like about the debit card is you have a balance. Maybe you have $500 in your checking account, and you use $100 in a debit card, but you don't annotate it. Now, maybe you're online and you have your phone and you're looking at your balance at all times. So the next time you're going to spend it, um, you access your account and it says, well, no, wait a minute, I only have $400. I don't have $500 left. Well, you can't do that with the debit cards. You can do that if you're online and you're looking at your phone and that's how you're making the transaction. Maybe it's because I'm an old guy, but I just find that to be more confusing. Whereas the credit card, now again, a debit card is money that you have. If you overspend with a debit card, you're either going to be denied the purchase, which is actually a better scenario, or you're going to be issued some sort of overdraft, just like if you bounce a check. That's unnecessary fee that tarnishes your financial reputation unnecessarily. With a credit card, of course, you have a limit. Okay. You have a limit as to how much you can borrow from the bank. So here's a rule on a credit card. Depending on which credit card you have, and you have Samuel Jackson doing Cap One commercials and different banks and stuff. I love credit cards. I love to rack up miles so I can get airplane miles or hotel miles. But the rule is you have to pay the card off each month. They love it when you don't pay the card off each month, because the interest rate can be 10, 15, 18%. And there's teasers. They say, oh, open this card, and your rate on the balance is 3, 4, 5, 6%, maybe even no interest for a while. Um, they're not lying, and they're not denying that it steps up later. But think about 16% balance. We're going to talk about this in savings and investments. Excuse me. Just cleared my throat. So the rule of 72, you multiply time by the interest rate. And when that equals, that's when your money doubles. So if you invested money at 18%, and each year for 4 years, it would double after 4 years. That's really cool. Guess what? If you borrow money or owe money at 18% and you owe $1,000, and you maintain that owe balance, the balance that you owe because you only pay the minimum, you're going to owe 2,000 instead of 1,000 at the end of 4 years. You don't want to do that. You cannot deduct the interest that you pay on credit cards the way you can on your mortgage. Okay. So I'm not your dad. I'm simply telling you credit cards, banks, or financial institutions love them because they charge you the interest in order to lend you money. A debit card is your money. It's got some risks, it's got some advantages. It's your money, it's finite. Credit card, you can borrow all the way up to the limit, you can pay the minimum, and you can accrue massive, non deductible interest charges. Please do not use a credit card. Just simply do not use it. Um, Unless you can afford to pay it off full each month. If you can afford to pay it off full each month, then that's great because you earn a bunch of credit cards. You earn a bunch of points. Now you might say to me, "Well, now you must be a really sweet guy if you can pay off your credit card each month." My response to that would be, "You're living above your means. Do not view the credit card as a source of money. You simply have to live within your means. You have to we'll go through this again in the budgeting block, but you earn what you earn and you spend what you spend. You can't spend more than you earn because you're going to get yourself in a very bad situation. So with a credit card, don't think of it as easily accessible money. Be really clear. It is a financial institution lending you money at an extremely high percent. Even if it starts off for the first 6 months at a low percent, it'll ultimately grow to a super high percent. There's something called the grace period. This is a period beyond which the stated bill is due before they apply the finance charge. And the finance charge is what they charge you on the balance that you owe, and a late charge if your bill is late. Oh, by the way, we'll talk about this. I think it's Monday, a couple days from now, in the credit section. It can affect your credit score. Talk about sliding down a slope of bad situations. Imagine you owe money and then you borrow money, but then you can't pay it off or you can't pay it off in full because then you owe more money because the interest rate charged is gigantic. And then you try to borrow money because you need to buy a house or you need to buy a car or something because your other car broke, but your credit score stinks because you continuously pay your bill late. We're going to go through this in the credit section. Just please don't do it. Please don't use a credit card. Do not use a credit card. Either reduce your expenses or earn more. Everybody wants to earn more. You probably have to reduce your expenses first. Do not use a credit card unless you can pay it off in full. Related to this, because a credit card is a loan that many people do not realize is a traditional loan. There's all kinds of loans. Just to give you some terminology, and I apologize if this is basic to you. You have principal, that's the amount that you're borrowing. You have the term, that's the period for which you're borrowing it. Not everybody, but it will be common that somebody would take a 30-year loan. Some people take a 15-year loan. Some people take the loan and add extra money to the payments so they can pay the loan off quicker. You can deduct your loan up until a limit, which is 10. It should be $10,000. Excuse me. Based upon the last tax law that was passed, you can deduct up to $10,000 of interest in your loan. For most people, that's really not an issue. Your APR is your annual percentage that you're charged. Some people borrow money and they borrow it on a fixed payment. Some people borrow money on a floating basis, which means, well, there's an index called LIBOR that's going away, or treasury bills plus a margin or plus a spread. So they might say you borrow this money and you pay the 3 month T bill plus 2% or something like that. Those can be risky because they can go as high as that index goes. If you happen to have an opinion that rates are going lower, or if you happen to think that the all in number, treasury bills plus 2%, is less than, say, the fixed number, 5%, maybe you think about it, but you got to be very clear. Um, on the exposed base when you take a floating loan versus a fixed loan. Um, and one thing that's always sort of safe is whatever you borrow, if you have extra cash, you can always try to pay the loan off quicker because you do deduct the interest up to a certain amount, but you are paying that interest. It is out of money cost. Okay. Points is the percentage of principal that you pay up front upon signing for the loan. Maybe 1 point, 1.5 points. So if it's a $100,000 loan, you pay, excuse me, yeah, $100,000 that you're borrowing, you might pay a point, $1,000 at the time of signing, and then you owe a certain percent. So with loans and with budgeting and all these things, even though there's five distinct modules, they're all quite related. We want to keep our credit score as tidy as we can. We want to save for the future as best as we can. We want to defease our liabilities. We want to rein in our spending to make sure it's not excessive. With a loan, my rule on borrowing money is you can borrow money for education. However, you should go to the best school you can get into and get the best grades you can. If you go to a stinky school and get stinky grades, you almost kind of wasted your time. And don't be surprised if you're going to have a difficult time getting a good job and being able to pay that loan off. It doesn't matter where you're from or what your parents' background is. I told you in my case, my father didn't graduate high school. Wonderful, wonderful man. He's gone now. But you apply yourself and you go to school. There's no constraint as to how far you can go. Just pay your debts off, save your money no less than 10% of your paycheck, and accumulate that towards the future. As far as borrowing money well, the second place where you borrow money for besides education is a place to live. But the monthly cost and the overall costs, excuse me, needs to be within your means. You don't want to get over your skis and overextend yourself so that you have pressure. But again, if you take the loan because you don't have the money currently, but you do responsible budgeting, or you earn some more money, or you come across some money, you can always add extra money to the monthly payment, or even sometimes double the payments, or add an extra payment per month. You could talk with the lender about a variety of choices, and you are all eligible, if you're a veterans, for USAA. So USAA is a very solid institution. It's a place for you to borrow your money or borrow money from. And you all should be eligible for VA loans as well, which are preferable term interest rate. You can go online. It's easy to find VA loans. So the next bullet here, I talk about the direct deposit, that it's crisp and safer, a lot safer than walking around with a check or cashing the check and getting cash in your hand. It's just a lot safer. I talked to you about establishing a bank relationship and an identity. I just can't see how a financial institution, or excuse me, I can't see how you'd be hired or how you'd want to go have a financial transaction as an adult and the person who you're interacting with. I just can't see how they wouldn't say, what's your bank? What's your bank account? How long have you had the account? If you switch banks every 3 months or every 6 months, it's a pain in the neck. People don't like to see that. They like to see stability and continuity. If you are having your accounts with USAA or Navy Federal Credit Union or whatever, merchants and counterparts, financial counterparts, like when you've been a client, for a certain number of years. Another advantage, and I have it noted here, when you have a financial institution whom you have continuity with and your funds are there, and they'll say, oh, well, if you have a direct deposit with us, then we'll do such and such for you. Things like wiring funds. Sometimes instead of mailing money, you're in a rush or you want it more secure. It's a large amount of money, so you wire funds. That's something you would do with a financial institution. And then I refer here your financial reputation. And if you want to borrow money, you're going to have a much better chance if you had your bank account or your money or your check being deposited to some place. Either, hi, I want to take a loan, and here's my firm, and here's how I get my check every 2 weeks or whatever. Or if it's a place, either a place that you're starting a relationship with, excuse me, either a place you're starting a relationship with or a place you've had a relationship with, you're going to have a much easier time borrowing money and having that financial institution back you. Bill paying. Again, I'm not trying to be too basic, but we have a spectrum of people here. So some people like to go and pay their bills in cash. I don't think I would do that because you can lose the money or have it robbed. Um, Again, we're talking about establishing a financial identity. When you go to borrow money or you go to have a financial interaction, financial companies like it when they say, oh, this guy or girl has had an account here for 2.5 years or for 10 years. Um, there's a record. Now, you can get a receipt when you pay for something with cash, but there's an easily accessible record when you do bill pay online or credit card if it's allowed. Although be advised that many merchants these days, because they get charged a fee by the credit card company, they charge you as much as 2 or even 3% for the convenience of using a credit card. So if you're the kind of person who likes to rack up credit card like me, but you pay them off each month in full, so you don't suffer any interest rate charges, you have to be careful that whoever you're paying doesn't charge you a fee uh, to use to use the credit card, because that's that's going the wrong way. Okay, so we talk about reconciling your checkbook, balancing your checkbook. Many people do it, some don't. So every month you'll get a statement. It's either online or it's in paper, and you have to reconcile or adjudicate. You have to tidy up your checkbook to make sure that you can account for and agree with everything you spent, everything you received, and that the balance that you think you have agrees with what the financial institution thinks you have. If you don't do that, you're setting yourself on a path where you can bounce a check or have some sort of inconsistency over things like this. An overdraft or a bounce check is when you write a check to a merchant. Say you wrote a check for $75, but you had $50 in your bank account. The merchant goes to the institution that issued you the check, like Citibank or whatever, and says, "Here, I present this check for $75 from Tim Jones." Well, Tim Jones only has $50 in an account, so they're going to bounce the check, and then the institution is going to charge you a fee. It could be 20, $30. It's just no good. I think here one of the next thing that I write is accessible records of financial institutions, financial transactions. Either doing online paying or, again, having a relationship with a major financial institution, it's a lot tidier than having cash and having to save all your receipts, even though the information conceivably could be similar. I think it's a lot tidier for you, and it's a lot more accessible if you have it online. One thing I write here is ATM safety. So we all know that, unfortunately, depending on where you are in the country, depending where you are in the world, there are thieves, there are dishonest people who try to rob people. And if you can believe it, I will read stories from time to time about somebody across the street from a bank with a telescopic lens, and they actually try to watch the person log in and steal their PIN. And maybe they can figure out a way to access your account or use one of these hacking things, or you lose your card, but then they have your PIN. Don't debate and argue. Just what you do is you put your hand over the screen so you can see the screen, but as you push in your PIN and push in your transactions, just cover it so the person behind you or the person across the street can't see it. And always be conscious when you're drawing money, especially if it's an ATM that's outside in the street, but even one that's inside the door that you have to use your card to get into. Be conscious of a vagrant or a thief or somebody who comes in there while you have, let's just say you have your pants down, while you have the account open and the thing is ready to spew out money to you. Just be very aware of your environment. I'm not trying to insult your intelligence as far as safety, but be very aware. Be very aware of somebody who's spending too much, who's paying too much attention to you. Be very aware of a poorly lit facility. Be very aware of nobody being around, and all of a sudden someone comes walking up, especially if they look shady. So, um, another thing that I refer to in this area here is a certificate of deposit. That's something that you can get from a financial institution. And what that is people often say, well, people are saying these days, and we'll talk about this in the savings and investment block, gee, where should I put my money? The equity market frightens me, and the bond market frightens me because rates are sort of low, but they're going higher. And by rates going higher, my bond investments lose money. So one thing you can do is you can roll CDs by oh, by the way, it says CD, a certificate of deposit, is issued by a financial institution, and you say to them, here's my money for a period of time. It might be as short as 3 months, it might be as long as 5 years, and they say to you, thank you, we guarantee to pay you such and such interest for the use of your money over a period of time. I'm quite sure this is the same protection or insurance as the $250,000, but you want to make sure it's insured. The institution is insured. And the good news is you get that fixed return. The bad news is that the return might be low, but the worst news is if you need the money and if you take the money out and you cancel the CD, there's typically a fee. So you want to be very careful with being clear whether or not you're going to need that amount of money. So this is what I was saying. If you think rates are going to rise, if you think the Federal Reserve is going to raise rates, one idea is to take 3 month or 6 month CDs, take the money and roll it, because that way you're only losing it for the 3 months or the 6 months at a time. Hopefully you won't have to access it for that period of time. And then you're able to capture as you reinvest it the rates that are rising. Another thing I write here is loans, co-signing. Sometimes someone's adult child or a friend or anybody will say to you, hey, can you co-sign my loan for me? Because I'm trying to co-sign my lease. I'm trying to rent this apartment. I'm trying to borrow this money. It's none of my business what your personal relationship is with the person, but be completely clear that when you co-sign, you are completely liable for the behavior of the other person. If you have a roommate and you're renting an apartment, you two are, let's not to be inappropriate, you are vulnerable to each other's habits. If you share the electric bill, or he or she, you do the phone bill and she does the electric bill, or vice versa, well, I guess if it's in their name it wouldn't matter, but anything that's in a joint name, whether it's a loan or a lease or anything, you are responsible for that other person. So if they don't do their share but it's co-signed, then your reputation, your financial posture is you're gonna be vulnerable to the negative ramifications, and you're going to get crappy scores in your credit score and things like this. So be very, very careful about doing that. And I think on the bottom here, I've written auto investing from a checking account. And I'll say that again, in the savings investment, when you pay your bills, the very first bill, ideally, and you should actually make this happen, is to pay your investment account first, because that ensures you remove the emotion. Oh, gee, should I do this? Should I go on vacation, or should I pay the investment? How's this sound? How about you have it automatically deducted from your checking account when your paycheck comes in? If your paycheck comes in on the 15th, have it taken out on the 16th. So there's no decision. There's no temptation for you. You just have it automatically invested. So we are about done here. The only other page, I'm sorry, I'm just advancing here. We're past that. Okay. Oh, this page here. I'm sorry. This is a sample pay stub. Did I lose it? I think you've all seen a pay stub, because even as in the service, you have received your money and you probably got a paper pay stub. I used to. I'm not sure if they changed that, but just to go over this. So you get your income, whatever it might be, $1,458, hopefully more, who knows. You get tax taken out. You get federal income tax taken out. You get state income tax taken out, depending on what state you're in. Some states don't have income tax. You are required to contribute to Social Security. Some people find that outrageous because they don't know if it's even going to pay by the time they get to the retirement point. Either way, you have to pay into it. You have to pay into Medicare. I put retirement savings account on the bottom. Actually, it should be on the top. If you have a 401k with your company, do yourself a favor and either match it or, at the very, very minimum, pay in as much as the employer will match. So if the employer will match the first 4% that you contribute to your 401k, ensure you contribute at least 4% of your paycheck. Preferably, you can maximize it so you can do the maximum each year, which is something like 24,000 a year or something like that. And the other thing there is health insurance. Some people, they get the health insurance for free, like we all did in the service, but in the civilian world, you typically have to pay for your health insurance. And sometimes you have things like healthcare spending accounts and healthcare savings accounts. That's a little bit beyond this, but I usually show the sample pay stub just in case. So that is that. If there's any questions, I'll answer them. Otherwise, I hope you found that useful. I tried my very, very best, and I hope this was valuable information for you. Thank you very much. That's it.